Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
So good morning, everyone. Welcome to the Navigating Evolving Global Markets panel. My name is Mark McEvely, Chief Investment Officer and Managing Partner at Jessup Wealth Management, just down the road a ways in Dayton, Ohio. Really excited to be up here moderating this panel again this year. I did it for the first time last year and had a really good time, and we had some really interesting conversations. And I think this year's panelists are going to offer some invaluable insights that hopefully everyone can take some tidbits away. So with us today are Travis Upton, CEO of the Joseph Group Capital Management, located here in Columbus, and Scott Martin, Chief Investment Officer at Kingsview Partners in Chicago, Illinois. So gentlemen, thank you for being here and chatting with me today. We are going to leave some time, as Quinlan said, at the end for Q&A, so feel free to jot down any questions that you might have for Travis or for Scott at the end. So let's get right into it. So 2025 has already presented several challenges to investors, including tariff policies, geopolitical uncertainties, and what the Fed's doing with delaying their rate cuts. So to start, can both of you just touch on your global outlook for the next 12 to 18 months and let us know what you guys think are going to be shaping markets and what regions or economies look most compelling or concerning to you right now?
Sure, I'll go ahead and start it off here. And I'm actually curious. I would love to kick it off here, get some energy going first thing in the morning. But I'd be curious to get a sense of the mood of the room, given everything that's going on, here in the world. So just show of hands, how many people in the room would consider themselves bulls? Economy's in great shape. We're off and running. Market was up big yesterday. Everything's positive and thinks we're going to be in great shape here for the rest of the year. Show of hands.
There you go.
All right, we have like 3 or 4. Let's take the other end of this. How many people would say, market has bounced back from all of this tariff craziness, but when we look ahead the rest of the year, we got some pretty tough sledding, and I'd consider myself a bear. Okay, no hands. How many people have no idea, and that's why you want to listen to us? Okay, there it goes. There it goes.
Who doesn't like to raise their hand?
Right. Well, that could be too. Let's go on. So I think the beginning here, very loaded question, and I'm sure we'll get into some of the different things about this. But obviously, if we go back to where things were in November of last year, I would say there was a lot of excitement that was going on, particularly from a political standpoint, and remembering what the market was really doing, what the market was like during President Trump's first term. And immediately after the election, we saw a spike in the value of the dollar, we saw U.S. stocks rally, and really this idea, I would say, of U.S. exceptionalism that was going to rule the day. And I think it's been pretty surprising to a lot of market participants that as 2025 has played out, that's not what we're seeing. The fact that we've seen about a 10% decline in the value of the dollar, that's been something that has really propped up international stocks, as I'm sure this room knows. I think this whole banner of U.S. exceptionalism, where that's not the mood, that's not the tone in the world. And I know when we're talking to our end clients, I mean, I would say there's really two big things out there. There's a lot of people that are just saying, I don't know what to do because you don't know what the next news headline is that's going to drop next. But then there is definitely a political polarization that I think is impacting investor psychology and impacting investor decisions. I mean, I saw a couple nods as I just saw that. If we are sitting in front of a client and that client is leaning to the right politically, they are pretty optimistic. They don't think we're going to see inflation. They think that tariffs are going to be a good thing. We're going to pass this tax package, and they are generally pretty bullish on the economy. When we talk to clients that are much more left-leaning, they think the sky's going to fall and the world is going to be over within the next 6 months. So with all of that kind of rambling, I would say the truth here is somewhere in between, and I think that the market is sorting that out. And Scott, before I stop rambling here, and I guess the final what's that? Love it. I would say one of the things that we have tried to tell our clients, and I think it is something to remember, markets tend to respond more to better, worse than they do good or bad. And regardless of how you feel about the tax environment, the tariff environment, the political environment, it may be bad, but if things are not as bad as what people might have been starting to price in or expected, it's bad but getting better, that is going to tend to be positive for the markets. And I think last week's events of what we've seen geopolitically, I think we've seen some of that come into play.
Yeah, and I think too, markets overshoot on the upside and downside. And it's funny to look around today, as you mentioned, Travis, with where we are, give or take on the S&P, up a couple percent, NASDAQ similarly, global markets, as you said, Mark, up a little bit more. And think about where we are on a kind of a nominal basis, and look at all the work we've done to get there. It's been a very noisy year so far. I mean, this has been a crazy 6 months, and I think that's kind of going to be the situation going forward, is that we did all this work, we did all this running around, we did all this working out, whatever it is, to get to where we are now at about 2, let's say plus or minus 2 or 3%. And I think that's the work that the market's done to get here, where that's the big activity of the year. And I think the rest of the year is probably going to be a little bit of not a downer, but a little bit more of a calm situation, because I think we got through a lot of that anticipation of a lot of things that happened with the Trump administration taking over some of the geopolitical issues. Some of this, which we'll get into probably here, some of the kind of Pollyanna economic situations, and then obviously the sky is falling type, Chicken Little type of economic situations, neither of which really happened yet, frankly. If you look around at just kind of we look at a lot of fundamental analysis and how we run our portfolios for our clients, and if you look at things like GDP, you look at job growth, you look at wage growth, those numbers are all still pretty decent. Yeah, we had kind of a stinker of a GDP number in the first quarter. It was negative, just under 1%. But then if you look at the future forecast for GDP for Q2, we're going to bounce back up about 3.8% for Q2. Job growth is still positively above 150,000. Wage growth is still above 3.5%. There's a lot of things out there. Earnings growth too, quarter over quarter, double digits. There's still a lot of great fundamental strength in the economy, at least in the U.S., and that's your question, Mark. We still like the U.S. more than any kind of global economy, just because of the fact the U.S. has kind of lagged so far behind a lot of the other economies around the world because of the currency situations, and because of the fact that I think the U.S. economy this whole time, maybe it is because of the political bias of many of us, because I think this has been a little bit more of a difficult, let's say, Trump administration than it had been the first time. I think that the likelihood or the overall mood has been, well, the economy's not as good as we think it is, or the economy stinks, or this is going to happen, the next thing is going to happen is the next shoe to drop versus the next sun that's going to come out. And the reality is, I think the economy in the U.S. has been a lot stronger than people think. And so I think the markets are starting to show that with just a little sliver of good economic news, as we've seen, whether it's a ceasefire between Israel and Iran, whether it's some earnings growth, whether it's a pullback that we're now seeing in crude oil prices, that's starting to really bolster stock prices, and therefore give that investor confidence back. Therefore, that we're starting to chase some of these all-time highs, or soon-to-be all-time highs, I think, in the S&P and NASDAQ, that will continue to get maybe more of a calmer situation going forward as we go into the fall and we get maybe that big, what do they call it, the big gorgeous or big beautiful bill passed. Yeah, as long as that gets passed, I think there's things that will come along the line that will help kind of soothe everything and get us out of this kind of crazy economic, or crazy, let's say, volatile economic environment that we're in for the first 6 months of the year.
Yeah, thanks, guys. And let's dig into that a little bit more when we're talking about domestic equities versus international equities. I don't think it's any secret that the dollar has been pretty weak so far year to date, and I printed this off. Is anyone familiar with the term the magazine cover indicator? Has anyone ever heard of that? So this is a magazine cover of The Economist in the fall of 2024. So it was essentially a wad of $100 bills shooting up into the sky like a rocket ship. And the title was, "The U.S. is the envy of the world." And I think we all know just a couple months after that, the dollar had its most severe decline in quite a long time. Do you guys think this is something that is going to be prolonged? We've seen short periods of outperformance from international equities before, but they've never really gotten going over the long term. So I know, Scott, you touched on this a little bit, but Travis, interested to hear your opinion on this, and then your just opinion on the dollar in general, because again, The Economist came out with another magazine cover indicator in April talking about how the dollar is doomed. So are we at a point now where the dollar has bottomed and we're about to rise again, or how do you guys feel about that?
Sure, I'll take first swing at that. And I would say at our shop, with portfolio construction, I want portfolios to be global. And part of the reason why I want portfolios to be global, and that means US and foreign, and I think if you look at the makeup of the ACWI, we're probably about 2/3 US, one third foreign. And I think that in that kind of ballpark is about right. And the reason why we want that is because we want our portfolios to be anti-fragile, is a word that I use a lot, and make sure that we're ready for anything. So, do I think that we could have a prolonged period of dollar weakness? I actually do. We saw that coming out of the technology bubble. That was the last period of time where we saw a prolonged period of international leadership. I remember managing money in the early 2000s, and if you had a small piece of international equities in your portfolio, you looked great to your client that was comparing that portfolio to US indices. And I think we could be in another period like that. The other reason why I want to make sure that portfolios are global and have that international component, it may sound counterintuitive, but I think deglobalization is a huge tectonic force that is going on in the world right now. Globalization and having everything come together, I think that was something that really supported US dominance, because the United States was dominant in the whole globalization theme. I think as we get into doing more deglobalization, I think the winners and losers are going to be a little more spread out there. One other comment that I'll make, I think it was a JP Morgan chart, but they put something out a number of months ago that took a look at comparing the US stock market and then what would happen if you took out NVIDIA. And their conclusion was if you took out NVIDIA, the other S&P 499 actually would have lagged the global market here. So I think those little tidbits are something to be thinking about. Part of the US dominance has been our technology dominance. It has been the fact that companies like Apple, Microsoft, and NVIDIA are all US-based companies. If those companies are not necessarily going to be the leaders going forward, and maybe we'll get into valuations and things, I think that sets a stage for the potential for other areas of the market to potentially be winners. And I would rather be in a place when I'm sitting in front of clients to be able to be honest and say, I don't know exactly who's going to be the winners coming out of this, but I do know that the portfolio that we're trying to manage for you, Mr. Business Client, and based on the objectives that you're trying to achieve, we've got things that have the potential to win regardless of how things turn out in the world.
Yeah, I mean, for us, we tend to stay more domestic, just because we know it better. I think it's somewhat challenging sometimes, with especially emerging markets, with their governments, with their central banks, who are very inexperienced to handle some of the economic kind of challenges that they have, as we've seen over the course of time. If you just look at the overall slope of, say, the equity curve and, say, the emerging markets and even foreign developed markets, sometimes that Sharpe ratio is just not worth it. In fact, if you look at emerging markets over time, they're not positively sloped. So it's like, is it worth the risk of emerging markets to hang in there for the long time versus, like, say, the domestic markets here, where it is positively sloped? We have a positive Sharpe ratio. We have prices that go from the lower left to the upper right. And so, in our opinion, we stay in the S&P, we stay within the NASDAQ, because a lot of times these days with the globalization that you mentioned, Travis, a lot of the companies that are domestically based here do have a lot of revenues coming in from overseas. In fact, if you look at the S&P 500, about half of the revenues come from overseas nowadays, and so the benefit that they get from the currency exchange to factors into their stock prices and things like that. So given that the data points that we look at are so fundamentally based in the US, when we look at jobs, GDP, wage growth, and things like that, earnings, those data points to us are very, very held here closely so that we stay pretty much within the US, knowing that we still get that global exposure, but you don't get a lot of that political risk and a lot of that central bank risk that you see from those foreign governments. Now, that's a funny thing to say, given that, like you mentioned, Travis, with where you lean on these clients. I say that to a left-leaning client, and they're like, well, Trump's running this place like a banana republic. I'm like, yeah, probably. And then a right-leaning client will come in and be like, Trump's the greatest president we've ever had since Reagan. So it depends on what your viewpoint is there. But the reality is the answer to what you said, Travis, is correct. The answer is probably somewhere in between. And I try to block out the noise in the day-to-day and all the press conferences and everything these guys are talking about in D.C. I still believe that the U.S. is still where everybody wants to be and still where a lot of the foreign dollars want to come. And if you talk to any kind of foreign person that comes over as far as business and things like that, they still talk about the U.S. as still being kind of the head of the top of the heap here, at least for now. And as long as that still, I think, remains the same, I still believe that the U.S. is the place that we want to stay and want to be, and where we can rely on the data the most to determine where we're going to put our portfolio assets.
Yeah, no, I'm glad that we on topic number 2, we have some healthy debate. Not that we have disagreements, but I think it is interesting, Travis, to your point that you made the comment if you took out NVIDIA that the U.S. actually lagged global indices, and I think it'll be interesting over the next couple of months to see if tech bounces back quickly, because I think something that not a lot of people know is other global indices are not tech dominated, right? They're dominated by financials and industrials, and we're seeing a year like this year where European financials are breaking out to all-time highs. That's a really interesting situation. So turning to another not popular topic, tariffs. I think this is probably the hottest topic on people's mind. The proposed tariffs from the Trump administration kind of sent U.S. equities at least into a tailspin there in early April. Do you guys see the tariff proposals as being a serious policy shift, or is it posturing from the administration? And if it is posturing, I think the administration pushed it to the brink until they implemented that 90-day pause on tariffs.
I'll take a swing at that at a couple different angles. I do think that it is a policy shift here. And I'll go back to what I said earlier about markets tend to respond more to better, worse than they do good, bad. I don't know if President Trump realizes this and the whole idea of, hey, we're going to have these crazy shock and awe tariffs that are going to, blow everybody away and, be willing to tolerate a few weeks of market turmoil. And then say, oh, back off, it's not going to be as bad, we'll make it better. I mean, we see how the markets responded to that. I do think that there are some key policy shifts that are going on here. If you listen to President Trump, and I believe him, he wants to restore U.S. manufacturing. He wants to take areas of the United States, like a stupid bill that might have been at one point a great town with steel manufacturing, and now you look at the city and it's kind of hollowed out. He has a dream of wanting to restore some of that. And that gets into this whole deglobalization theme. And while I don't think we're necessarily going to have 50% tariffs on every country, I do think that tariffs are here to stay. I think that the deglobalization theme and what that does to try to push U.S. manufacturing coming back in different areas, I think that is a legitimate policy shift. I also think, and depending on some of the different data sets that you look at, tariffs are actually bringing revenue into the government coffers. We actually have revenue coming in from the tariffs, and that is something that we might get into the debt deficit here later, but that is something that arguably the United States needs. And with the big, beautiful bill that's coming up later this year, where we are going to see some tax cuts, there needs to be some political cover for some revenue coming into the United States. And I think tariffs do that. So, that is, I think it is a legitimate policy shift. We may get into some of the, I'll share this. We had a conversation at our shop just taking a look at who are some of the companies that year to date, as the stock market has recovered, who's still lagging and who's actually winning here. And I think one of the surprises, and people in this room may know this, if you look at a company like Apple, year to date, even though the stock market's positive, I think Apple's stock is still down about 20%. And there's an example of a company that is seeming to be hurt by some of the legislation, by some of the tariffs, the shifts that Apple may need to make in some of their manufacturing and what that may do to their margin. So, there are losers out there, but maybe a surprise to a lot of people. You look at Walmart stock, you look at Costco stock. I mean, I think they're up about 9-10% year to date. You would expect tariffs to be this additional weight tax on the consumer. We're simply not seeing it. So it's really interesting when you look at the whole tariff thing. I think they're here to stay, but the winners and losers might not quite be what people expect.
Yeah, and I think Apple at year-to-date lows pretty much, and Costco and Walmart net importers at year-to-date highs, right as we approach tariffs, which to me tells me that the market is either calling Trump's bluff on some of this stuff, or just doesn't believe that the tariffs are really going to have that big of an impact. I personally think that the tariffs are just blustering. I think Trump, somewhere I hope in his heart, knows that we can't bring manufacturing back here to the degree that he wants to. I mean, Trav, we're all from Ohio, and it's like you go up to Cleveland and some of the Rust Belt areas. Listen, I love Cleveland. I went to high school up there. Some of those areas are not coming back, ladies and gentlemen. I mean, they just aren't. We don't have the structure for them. We don't have the labor. We don't have the regulations. We don't have some of the environmental allowances for that stuff to come back, at least as we know manufacturing today. It could take decades to get that new kind of solar and all that stuff manufacturing back in there, which I would love, don't get me wrong. But right now, that stuff is still in this global phase where I think Trump, I believe it in his heart knows that while he wants to go out and say, we want to bring manufacturing back, we want to bring jobs back, we want to give companies the incentive to bring all this stuff back, I think he knows that we can't do that. In fact, we can't do that in 3 years that he's got left on his term. So to me, I think this is just a kind of posturing that he's doing with some of these governments around the world, some of these economies around the world to try to make the U.S. stand tall again. And we all know what the kind of, I think the biggest thing that the U.S. kind of has going for it. One is the capitalist society and the fact that we have the kind of best business environment, at least we did for a while, the best business environment where people want to operate. And then two, we're the biggest spenders. We're the buyers. We're the people that folks want to sell to around the world. And so we're the ones that, like, if you have the Walmarts of the world, we're the ones that the Walmarts open the door, that the Walmarts open the doors for, and we walk through because we go in and spend our money there. And so for me, it's like, I think Trump's trying to just kind of levitate, if you will, and it's an interesting way to do it by making it very this boorish kind of talk. It's like, I think he's trying to levitate kind of the impression of the U.S. out there again to make us kind of look like this big economic integral part of the world. And so I think that's kind of the way that he's kind of doing it. And I think the tariffs, just if you look at it on balance, whether it's with China, whether it's with Canada, with Mexico, these tariffs are all a major impact to all of our economies, like significant for jobs, for prices, for production. Like, you can't go out and just smash tariffs all over the world and say, hey, you're going to charge me 20%, I'm going to charge you 50%, I'm going to charge you 70%. That'll just grind everything to a halt. And Trump, hopefully, being a businessman, I'm kind of, depending on the day, I'm kind of a fan of his, kind of not. It's like, you've got to figure out that, like, this doesn't work mathematically and it doesn't work systemically. And so I believe that at the end of the day, when we come to this thing, we're at the beginning of the day, for Frank's sake, at the beginning of the day, we're going to realize, like, these tariffs aren't going to amount to much. I think these are going to come down to a lot of stuff that we had before with maybe a little bit of a different label on them. And somebody's going to walk away and say, I put tariffs on that, I put tariffs on that. And then at the end of the whole thing, it's going to be like you said, Trav, it's going to be like, well, you know what the government's going to say? Hey, you know what, Apple, if you pay a little bit extra tariff on that, we're going to give you a little tax break on that on the other side. You know, to make sure that you don't get impacted too much, because you're right, the Apples and some of those production companies in the world that they're doing production overseas are starting to feel the hit on some of those tariffs that are maybe not yet even yet to come, but the market is starting to discount them already.
Yeah, anything else you want to add there, Travis, as in opposition to your view?
I wouldn't say opposition per se. I think it's really an order of magnitude. I came to the point, I think the tariffs aren't meaningful. I think the tariffs are part of a bigger structural shift towards deglobalization. I think it's got to your point, Trump wrote a book, Art of the Deal. And, big picture, whether you love him or hate him, Trump's playbook is, I'm going to throw out something that is super outlandish, that nobody's going to believe. I'm going to take the other person that is at the other side of the negotiating table and scare them with the shock and awe, and then I'm going to back off to something more reasonable. That is Trump's playbook. That is how Trump has played all of his real estate deals, and that's how the country is being
That's
run.
why he's got his loans and things. And also, Trev, too, don't forget, we got so crazy with these tariffs that Congress started piping up and saying, well, we think this is unconstitutional. They tried to take away a constitutional right that he had to add tariffs himself. So they were trying to already say, like, whoa, these are too crazy. Like, Congress was starting to be like, we're going to take away his ability to even do that from a constitutional standpoint to try to get him to stop it. Sure. Because he'd rattled them so much.
Yeah. So I would just say of the, are things going to be of the order of magnitude of where the initial headline is? Absolutely not. Does the needle move, though, at the end of the day once the deal is done? Yes, I think it does.
And if that makes America in a better position, because maybe we get some stuff back from Mexico for once, maybe we get some strength at the border, maybe they stop the fentanyl crisis coming, maybe Canada, okay, fine, then we'll become our 51st state. Maybe the 51st and 52nd, because I think it's too big of a country to make one state, so you've got to slice them in half. So it's West Canada and East Canada would be 51 and 52. But then maybe we get some better, oil flows and things like that, gas and things like that, that might actually give us a better position with them when it comes to trade too.
Yeah, I think you guys brought up great points. I think, Scott, to your point, while it might sound good to reinvent American manufacturing, Trump has 3.5 years left. You need continuity of someone who thinks the exact same way that he does for the next 10 to 15 years, in my opinion, to get that done.
And
right?
you need people that want to work. I mean, all of us, I hate to speak about this. I'm going to be 47 on Saturday, by the way. And it's like we have a firm of about 60 people. And we have, this is going to sound terrible. I was born in 1970. We have some kids that work for us, okay? This is the next generation. What is it, Gen Alpha or whatever it is, Gen X, Gen Z. I guess I'm Gen X. It's like Gen Z or whatever the Greek letter is, Gen Delta. Like, some of these kids, quote unquote, don't want to work. Like these kids, we have people that come work for us that say, hey, you know what, we're going to take a couple weeks off. We're going to work from home on Fridays and Mondays and Saturdays. And it's like, some of that too is the labor force. We don't have the same labor force that we had, I think, in Gen Z, Gen Y, and before. I think that's another thing too that you got to think about globally, or at least think about domestically. Where what can we actually put in the factories? Who's going to work there?
Yeah.
Or maybe it's the robots.
Which is going to lead us into our next point. But just one thing to wrap this topic up, Travis, that you were talking about with, Trump announces these proposed tariffs, and then you have Costco and Walmart doing well, and this whole year it seemed to be kind of like opposite dates, felt like, right? So even just this past weekend, the U.S. drops bombs on several Iranian nuclear facilities, and people expect stocks to be down on Monday and oil to be significantly up, and it was the exact opposite of that.
In fact, they opened on the lows and then rallied ever since. Which is the lows were open on Sunday night at 6 p.m. Eastern time, right?
So just thought that's been really interesting to examine all year. But moving on to talk about the robots and AI, and we talked about this a little bit last year, and things have obviously progressed quite substantially since that point in time. As AI and tech continue to drive at least the U.S. markets, do you guys think this is sustainable, or are we setting up for a correction or possibly something even worse?
So taking a few, I'll make a couple different points to that. I mean, I think AI is real, AI is here to stay, AI is going to be something that changes the way we operate. It already is now, and it's going to change things in the years ahead. We've already had Andy Jassy with Amazon talking about how there will be fewer jobs at Amazon in the future because of AI. So I think that we need to take that seriously. I think coming at it from an investment standpoint, it's challenging. And if we look back at the tech bubble in 2000, Cisco Systems was one of the darlings then. All of the backbone of the internet with routers and switches and servers, Cisco Systems was going to dominate. And if you would have had that view, you would have been absolutely right. If you would have bought Cisco Systems stock in March of 2000, I think you're still waiting to get back to break even. So I think that being able to define what is going to be a major economic shift and then how do you invest in it, that becomes two different things. And I'll share one of the things that we've been doing at our shop. One of the themes that we have in one of the portfolios that we have the privilege of managing for clients is cybersecurity. And so I've been buying cybersecurity ETFs, and that's something that we would venture to say, whether you love AI, whether you hate AI, there is probably going to be a tailwind to cybersecurity. So there's an example of, I think from an investment standpoint, it's huge, it's here to stay, but I think we need to be creative of how we are actually implementing it to make sure that we're winning on behalf of our clients.
Yeah, and I think you also got to make sure you buy stuff, like you said, Trav, that works. I mean, for us, it's like the energy side of that too. And I mean, I hate to use the word, but it's like nuclear energy. We're going to need energy out there. I mean, it's not going to be solar and wind. It's not going to be electricity and coal. Sure. So like we're going to need energy to supply the AI stuff, and we're going to need infrastructure that's going to both cool the data centers and things like that, but build out the data centers and connect everything. And I think to your question, Mark, it's like we're going to need AI to work. We're going to need it because at this point we've already gotten down the road, and I think the only way we're going to make this next phase of the economy happen, and the next phase of what we're trying to do here, and I think AI is going to be bigger than the internet, frankly. I mean, I don't know if many of you use ChatGPT, but ChatGPT is probably one of my best friends right now. I mean, literally, that's probably more of a comment on who I am as a person, but also in my personal life, but it's also in my social life, but it's also like the ChatGPT is freaking amazing. How quick it is. The accuracy, a little bit, but it gives you some ideas on some things. It gives you other ways to kind of think about things. It's very fast. It's very deep as far as what it can get access to, and it just has a way to kind of like, if you think about it, the expression into other things that the AI side of things is going to do for manufacturing, for production, things like that. It's going to have an ability to kind of double, triple, quadruple the efforts that we've done so far as how fast and how quick we can make things. So I think that's another part of the economy, another part of kind of how we're going, that it's going to have to be taking on its own life because of the fact that we've kind of already invested in it already, but also the fact that that's kind of the next move that it looks like the folks that are driving the economy want to make. And so I think it has to be the kind of next step that we take.
Yeah. Any other longer term themes that you guys are investing time, money, resources in and doing due diligence? Clean energy, we kind of just talked about nuclear, emerging market consumption. Any other key themes or industries that you guys are thinking about?
I think the security is a great call. I think you're looking at maybe some sort of transportation too. I think that's another way to kind of keep things kind of moving through the economy. And I think, any kind of communication and things like that is another way too, whether it's the fiber optics and things like that, and also, like I said, the infrastructure of things, because things are going to be more connected with AI because it's just so tight, and so connected because it has to be. I think those are areas too where you can look at like that infrastructure build out too, of where the economy kind of gets that reconnection, whether it's almost like we deglobalize, but whether we kind of reconnect the whole US because of the fact that we're kind of tied into this whole AI boom, this whole connectivity thing.
There was a great article, I think it had been yesterday here at the Wall Street Journal, but talking about the advances in robotics, and particularly for logistics companies of being able to unload a truck. That doesn't sound super hard, but when you get all the different size boxes and where things need to go, that is something that has been a job that has been heavily dependent on people, but also heavily dependent on people where there's lots of injuries and challenges there.
Risks, healthcare costs.
Absolutely. Yeah. And that is an area where advances in robotics have really started to take some jumps. Now, that's something, I don't know if the robotics themselves is the way to play that, or if it's some of the, even playing a REIT like Prologis, what are some of the things that are going to be able to save money for some of these logistics companies with some of these advances? I think there's a huge investable themes there.
Yeah, great. So shifting a little bit from market stuff to portfolio items, I think something that's always interesting for me to hear other money managers talk about is how you manage drawdown risk in client portfolios, because everyone loves the upside return in the markets, but if, for example, you're a buy and hold investor, that comes with 20, 30, 40, sometimes 50% drawdown. So how do you guys manage that when you're working with clients? Are there specific products that you use, or are you doing your own internal hedging or running your own strategies for that?
Yeah, probably a few different angles that we can take with that. One, I think that probably every person in this room has had a conversation about some of the different hedge products that are out there, whether it's buffer ETFs or something like that. I would say in a couple of the strategies that we have the privilege of managing for clients, we're using JP Morgan's Hedged Equity Mutual Fund. We've stayed away from some of the individual buffered ETFs because those tend to be so time frame dependent that you need the market to play out a certain way over that time frame to really play out. And if it doesn't quite play out, market runs, you've got, especially in a taxable account, a big capital gain and no upside left, and have to create a whole nother set of decisions. And so I would say we like some of those products that manage drawdown. But I think that we're trying to make sure, as we're using and applying some of those products in portfolios, how do we minimize the number of decisions we need to make and the chain of decisions that we need to make? One of the reasons that I will say that we like some of those buffered products in portfolios, and there's all sorts of academia out there. I know AQR and Cliff Asness have kind of said, hey, they're a bunch of crap. Just hold more cash in your allocation and you can get the same general effect. I would tend to agree with that from an academic standpoint, but when we're dealing with individual clients, we are not dealing with those clients in an academic standpoint. We are dealing with those clients in a psychological standpoint. And one of the terms that we've used in our investment strategy team when we're looking at some of these buffered drawdown products is they create conversational alpha. And in April, after Liberation Day, when everything was going nuts with the tariffs and we had about a 20% drawdown, our advisors being able to have conversations about the JP Morgan Hedged Equity Mutual Fund and the fact that it hit some of its stops and clients were automatically having some breaks in their portfolios, clients loved hearing that. And that was something that gave them a lot of peace, gave them a lot of comfort, and allowed them to stick with their strategy and their plan. So that is something that I would say with that regard. I'll go off on one other little tangent there. That we've had a lot of conversations too around the role of managed futures in portfolios. So I think that's another kind of hot asset category to be able to manage drawdown risk. And that's something that a number of years ago I had the opportunity to do some work with Kaplan Schweizer, the Kaya study notes. Managed futures are really interesting because they're one of the only asset categories that tends to be positively correlated with the VIX. So when volatility is up, managed futures tend to do well. So from an academic standpoint, there's some natural hedging capabilities there. It's just something that I think as asset managers, you've got to be really willing, if you're going to allocate to managed futures, to be able to hold through the whipsaws. And what we just saw with the big drawdown and the recovery here, managed futures have gotten clobbered, in that environment. So that's an interesting academic asset class to be able to manage drawdown, but really tough to hold through those short-term real-world market events.
Yeah, and I think investing, to your question, Mark, is investing has drawdown. At some point, whether you're a conservative investor or whether you're an aggressive investor, so the client, as it were, has to understand that there is going to be some point of drawdown. I mean, look at the last 3 years, bonds have been absolutely trashed, absolutely smoked. And it's like, if anybody wanted bonds to be this safe haven, this buffer, this kind of offset from equity volatility, that hasn't happened very well, has it? And commodities have a little bit to some degree, like you said, and managed futures and things like that. But like your typical, tried and true stock bond 50-50 portfolio, absolutely smoked at times. And so it's like all of a sudden, like clients need to understand that there are times when correlation shifts, when there are times when you've got to get a little more creative, whether it's those buffered ETFs, like you said, Travis, whether you said it's like managed futures or other things, maybe it's foreign stocks, whatever it is. And that's why, like for us, when we manage and construct the portfolios, we have ETFs that we've compiled, that we've launched, that have different asset allocations within them, and we switch those up because we look at correlation values, we look at kind of and stresses in certain asset classes and average true ranges, and figure out where they are when it comes to where they should typically be in a given market range or market cycle. And it's like you've got to kind of continuously manipulate those things. I think the idea, Mark, is well said, where you have to talk to the clients about drawdown, you have to talk about correlation, but you have to tell them, like, hey, there's going to be times when things are going to be bumpy. There are times when you mentioned, I love the term Liberation Day. I think that was April 2nd. It was like liberate your 401k from actually the gains that it had for the year, because you actually got smashed for about 3 weeks or 4 weeks after that. So that was like liberation day for the 401k to actually feel what it feels when it goes down. So it's like those are times that just happen, and so you have to get through those things, but know that if you have your long-term goal in mind, and if you have a chance to reallocate to some of the more, say, outflow-related things or some of the things that are more upside biased, when things go down, it's the worst thing, and you mentioned the word psychology, it's the hardest thing to do. You have to call that client, you have to be like, hey, I know the market's down 20%. Guess what I want you to do? Put more money in. And they have to, and when they do that though, it actually works. And it's when things are going really well and everybody's kind of cool, and that's what I like about your survey at the beginning, Travis. It's like, if people are really excited in this room, really, really comfortable, I'd be pretty scared. But the fact that people are a little bit nervous, a little bit unsure, that makes me actually pretty happy. It makes me less concerned, because it's usually when things are kind of going along, going pretty good, everybody's pretty hunky-dory, there's a lot to worry about, what we worry. That's usually the time that you gotta get concerned about the markets. When everybody's all doom and gloom and pissed off and worried about this and that and the other, that's usually the time when you should rush in and buy everything, because that's usually the time when things start to pop.
Right. Yeah. And one thing that we always talk to clients about, we always say, volatility is the price we pay to get above risk-free rate of returns in the market, right? And that's just something that we have to deal with. So thank you for that, guys.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.